authorities are fighting to stop the rising yuan. We tell you what's causing it. Earning reports are out. The weaker yen is helping some companies, but some big names are in a world of pain. Hello, you're watching Asia Biz Forecast. I'm Yuko Fukushima. Another step forward and another stumble. China is pushing hard to recharge its economy, but it can't seem to find traction. Manufacturers are still struggling to shake off the global slowdown. GDP growth for the first 3 months of 2013 disappointed many analysts. And the data out this week did little to cheer them up. This time, the warning lights are flashing in the services sector. Growth slowed sharply in April, hitting its lowest point in 2 years. HSBC's services PMI for China is a closely watched indicator. Last month's figure, released on Monday, fell more than 3 points from March. That leaves the index close to 50, the level that separates growth from contraction, and there's no sign of business picking up. The sub-index for new orders dropped to a 20-month low. Employment levels in this sector are also sliding. The jobs reading fell to 49.6, the first net reduction in staff numbers since January 2009. The weak results are not confined to services. HSBC's PMI figure for manufacturing, released last week, showed growth is slowing there too. HSBC's chief economist Hanbing Chu said the latest data has put a question mark on China's growth in the second quarter. The road to economic recovery, he added, could be a bumpy ride. Well, one headache facing Chinese leaders is an influx of foreign currency. The cash pouring into the country is strengthening the already strong yuan, and that's raising concerns about a property bubble. Officials have announced some tough measures to stop the flood of hot money. The yuan has been rising steadily for quite some time. The Chinese currency gained 1% against the dollar last year. It's added another 1.5% so far this year.
The rising trend of yuan since the beginning of the year is mainly due to two reasons. One is capital inflow, renewed capital inflow from the West, and also added to the fact that quantitative easing from Japan. And the other primary factor is the renewed growth optimism in China. Both of these factors has driven the potential appreciation of yuan this year so far.
A strong currency hurts Chinese exporters who are trying to reverse a 2-year decline in trade growth. But many analysts say the influx of hot money is also a major concern. It's adding fuel to an overheating property market. Officials are now taking steps to scare off the speculators. The State Administration of Foreign Exchange, a government watchdog, this month introduced a new rule that restricts lending in U.S. dollars. The aim is to curb bank loans denominated in U.S. currency. Foreign exchange loans rose by more than 6% in the first 3 months of this year. One reason is that Chinese companies have found a way to profit from the yuan's appreciation. Here's how it works. First, the company takes out a loan from a bank in U.S. dollars. They convert that money to local currency and then use it to buy yuan-denominated assets. Then they wait for the yuan to strengthen against the dollar. If that happens, a dollar-denominated loan becomes cheaper to repay in yuan terms. Selling the asset yields an easy profit. The new rule will limit this kind of lending. It sets a benchmark on a bank's outstanding loans, 75% of foreign exchange deposits. The ratio in question is called the loan-to-deposit ratio, or LDR. The higher a bank's LDR, the more tightly its foreign currency loans will be restricted. The foreign exchange LDR for China's banking system as a whole currently stands at about 170%, far above the new ceiling set for individual banks. This means banks will have to set aside more U.S. dollar deposits against their loans. Banks will be buying U.S. dollars and selling yuan to comply with the new rule. In the process, they'll be making life harder for speculators and perhaps helping to weaken the yuan. At least, that's what officials are hoping. The new regulations take effect on June 1st.
To rectify the measure, for example, on the loan-to-deposit ratio, there are the natural way for the company or banks to do is to reduce their foreign loan, to bring back to the benchmark threshold levels. But this is very hard because now the foreign currency loan is so much more than the deposit. So to reduce the loan immediately would be a little bit unwise. So what the bank could do is to either raise the interest rate on the deposit, i.e. to increase the deposit, but more effectively would for them to reduce the net open position of their book, i.e. the amount of dollar that they can hold or the amount of dollar they can short for their own purpose. So by doing that, it will create a demand for dollar and therefore reduce the appreciation of yuan. But these measures are very, very short term. It's not going to change the appreciation trend of yuan.
Well, the real change got an immediate reaction on foreign exchange markets. The yuan fell against the dollar for the first time in 2 weeks, but the impact was short-lived. That's because China's authorities had another announcement to make, the possibility of a free-floating currency. Premier Li Keqiang on Monday called for the drafting of detailed plans to make the yuan fully convertible. Officials have not given a timetable for a free trading currency, but the central bank is working on a blueprint for making the yuan basically convertible by 2015.
Well, I think it's very hard for a detailed plan because it's a market and it has to evolve. Even if you have a fixed plan now, it's very hard for you to carry out because it's a fairly open, kind of more open economy. So it's very hard for them to stick a fixed plan. I think the plan should involve a bigger framework. Say, for example, in 2011, they said that they want to try to have a full yuan convertibility in 5 years. So it may be 2-3 years before we are seeing that. But until then, we should see more natural fluctuation of yuan, perhaps again the wider trading band, more opening up on the trade in and outflow. Because to have a full convertibility of currency, the things that you have to have before is to have a more balanced trade flow, to have a more flow of currency before you can actually widening the band.
Well, analysts say that move to lift controls on the yuan also impact markets, but in the other direction. The yuan closed at a fresh high against the dollar on Monday. Well, next, a tale of two economies, Japan and South Korea. Corporate reports released this week indicate a change of fortunes is taking place. Many Japanese companies are profiting from a weakening yen. Rival companies in South Korea, meanwhile, are falling behind because of a stronger won. That seems to be a sharp reversal from recent years. A closer look at the numbers shows the story is more complicated than that. But there's no question who's the big winner in the latest currency swing: Japan's auto industry. Toyota Motor was among the many Japanese companies releasing its earnings report this week. Group sales for the year ending in March rose 19% to $229 billion. Operating profit increased almost 300%. The falling yen helped to push up profits, but the company says a key factor was growing sales in the U.S. and Southeast Asia. Managers say their efforts to cut production costs are also paying off. Despite the strong results, President and CEO Akio Toyoda says there is no room for complacency.
The persistent appreciation of the yen is ending at last, and the car industry is expecting growth, thanks to the recovery of the U.S. economy and strong growth in emerging countries. Some say the adverse wind has stopped, and it's time to take aggressive measures. But as far as I'm concerned, we've just come to the starting line for achieving sustainable growth.
Toyota's troubles started 5 years ago with the collapse of Lehman Brothers in 2008. The global financial crisis that followed in its wake dealt a heavy blow to the car maker. Sales plunged as economies around the world slowed to a crawl. In 2009, the company posted its first loss in 71 years, but more hardship was to come. A record depreciation of the yen, the 2011 earthquake in Japan, and floods in Thailand. Toyota says it is finally on the road to recovery. It is predicting another strong year ahead, with the falling yen playing an even bigger role. It estimates operating profit will jump another $5 billion. The firm expects the cheap yen will boost exports to North America and Asia, but that's based on an exchange rate of 90 yen against the dollar, a conservative estimate. If the yen stays weak, profits could be even higher.
I want to encourage everyone involved in the Toyota Group not to react to short-term changes in the environment, but to think hard how to achieve competitiveness that brings about sustainable growth.
Toyota is not the only one seeing improved performance. Fuji Heavy Industries, maker of the Subaru brand, reported sales of $19 billion, up 26%. It also posted a record operating profit. The company gives the credit to brisk sales overseas, especially in the U.S. and China. Once again, the falling yen helped to jack up the profits of its overseas operations.
Our products received a higher valuation, and the correction of the yen's appreciation also boosted profits.
Like Toyota, Fuji Heavy is upbeat about the coming year. It is forecasting a 50% jump in operating profit, and that assumes the yen will strengthen from current levels. Well, changing lanes now to South Korea. Car makers there have enjoyed runaway growth in recent years. Sales and profits have both climbed sharply. But things are slowing down for the country's largest automaker. That became clear when Hyundai Motor Company announced its first quarter results late last month. Anna Jun reports from Seoul.
Hyundai Motor, a global giant, struggling to keep a lid on cost. First quarter results show the scale of the problem. Sales are still rising, up 6% from the year before, with overseas sales providing most of the lift. The bad news was the operating profit, down nearly 11%. Two factors are hurting Hyundai's bottom line. The first is a strong currency. The Korean won has appreciated about 6% against the dollar over the past year. That makes its cars more expensive to sell in global markets. The second brake on profits is labor strife. Workers at Hyundai have staged a series of strikes since last year. They're demanding wage increases and better conditions. Managers agreed to cancel overnight shifts in January. Then in March, they shut down weekend production. It's not clear when the weekend shifts will resume. An analyst at Nomura says the strikes are hurting the company's global results. Hyundai and sister company Kia Motors still make many of their cars in South Korea.
Well, if they cannot produce, they cannot sell in the overseas market, especially. Hyundai and Kia, they are running out of capacity globally. And in the US and Chinese market, their plant utilization is over 110% plus. So if they cannot produce out of Korea, it is very difficult to meet the demand in the overseas market. The relationship with the labor union will be key for the growth of Hyundai and Kia going forward. But, unfortunately, recently the labor union is becoming more demanding. So the issue is going to be very, difficult to resolve, to be honest.
There's another reason Hyundai needs to worry: increased competition. Prices of European cars are dropping under the free trade agreement between the EU and South Korea. That's attracting the interest of Korean consumers. This dealer for German automaker Volkswagen is among those benefiting from lower tariffs. It has reduced prices by 5% since the FTA came into effect. The lower price tags have helped to boost sales by 20% so far this year, and the managers expect business to keep climbing.
Most of our new customers have been switching from Korean brands to overseas makers. Now there is very little price difference between our cars and the domestic makers. A lot of customers buy our cars because we are better in fuel efficiency and price value.
Other European car makers are also seeing sales pick up, and there's plenty of room to grow. Imported vehicles account for only 10% of the South Korean market. Competition is not just coming from European automakers. Japanese cars are making inroads here, taking advantage of the weaker yen. After years in the fast lane, South Korean car makers are facing some major obstacles to growth, both at home and abroad. Anna Jung, NHK World, Seoul.
Well, fresh action by the South Korean Central Bank may help Hyundai and other struggling exporters. The Bank of Korea cut its benchmark interest rate on Thursday by 0.25 percentage point to 2.5%. It's the first rate cut in 7 months. But there's one company that doesn't need the boost: Samsung Electronics. South Korea's leading electronics maker Samsung announced some robust earnings for the January to March period. It says operating profit grew 54% to $8 billion from the same period a year ago, while sales increased 17% to $48.5 billion year on year. The gain was thanks to strong sales of smartphones in emerging markets. With more than 60 million units sold over the quarter, Samsung soundly beat rival Apple with sales of over 30 million handsets. Samsung's high-tech success has helped it post unprecedented profits the past 5 consecutive quarters, though it couldn't break the number this time. However, company executives believe their latest smartphone, the Galaxy S4 out last month, will rewrite the records for the April-June quarter. Samsung's success has come at a heavy price for Japanese electronics makers. They're losing out in key markets from televisions to computers. Sony just posted a profit for the first time in 5 years, but a closer look at the balance sheet reveals the company's troubles are far from over. Sony shareholders finally got a break on Thursday. The company's earnings report declared a net profit of $430 million. Sales for the year ending March grew more than 4%. Sony says the weaker yen helped in the positive result, but it says financial factors played a bigger role. The advancing stock market gave the group's insurance company a lift. The group also profited from selling some key real estate, including buildings in New York and Tokyo. Sony's core business, however, continues to struggle. The electronics division posted a deficit of $1.3 billion. Punished by severe competition overseas, television sales dropped more than 30%. Its computer business also remains sluggish. Sony managers had set the goal of returning the electronics business to profit. Having failed to do so, all executives have given up their bonuses. But they haven't given up their pledge. On Thursday, they promised to get electronics back in the black. For the group as a whole, Sony is forecasting a 10% growth in sales for the year ending next March and a net profit of $500 million. It is expecting a yen boost for its business in Europe.
In the next fiscal year, we intend to make profits with real business, not by selling assets. Our primary task is to make the electronics division profitable again.
Sony is not the only struggling electronics giant in Japan. Panasonic reported a near-record net loss on Friday, $7.5 billion in the last business year. That follows a $7.7 billion loss the year before. Sales declined 7%, with TVs and cellular phones performing badly. Like Sony, Panasonic is relying on asset sales to underpin its finances as it tries to revive profit growth. It sold off a Tokyo office building and stocks in companies such as Toyota Motor. The company has forecast a turnaround this year, aiming for a net profit of $500 million. I talked to Masahiro Ono with Morgan Stanley MUFG. He's an analyst looking at Japanese electronics makers. I asked him why these companies are still struggling despite the boost from a weaker yen.
I think so. There are two major reasons. One is competition. So major Japanese, for example, TV set maker like Sony, Panasonic. So competitor is Samsung and LG. In case of Samsung, already they enjoyed very solid #1 position globally. So in order to catch up, so Samsung's position, Sony should, for example, Sony should spend more marketing cost or lower pricing. But lower pricing meaning losing brand strength. So that's why that is not a good way. And the second thing is procurement. So most of the Japanese TV makers, including Sony, already shifted to overseas manufacturing. And so usually procurement already US dollar basis. So current cheaper yen impact is not always so lower cost, but usually so price hike for component. That should be negative for profitability.
Looking ahead, what are your prospects for Japanese home appliance makers?
Still tough condition will continue. I believe one major reason is competition. So compared to the other industry like old mobile industries, so for example TV set so easier to enter. Recently, so newcomer like a Chinese brand name company so started, manufacturing TV set and also marketing itself. Looking at the potential demand growth in emerging region, I believe presence over such as Chinese brand name will be increasing. I think.
Do you think electronics makers like Sony or Panasonic will be able to do away with their TV businesses altogether?
I think in case of Sony, not unlikely. I believe they will continue TV business because Sony has potential to keep global top 3 position. Difficult to reach #1, but keep top 3, so should be okay. And so they have a contents business potential for making synergy each other. However, in terms of Panasonic, I believe it is possible. At this moment, not likely in the short term, I believe, because that is very sensitive decision. And however, so considering the company's position globally, and so focusing more of profitable business model overall, that is one of a good idea.
And now to other stories making headlines across the Asia Pacific. First to Indonesia, where the economy is showing signs of losing steam.
Statistics Bureau officials say the country's GDP growth rate from January to March was 6.02%. It's the lowest growth rate in more than 2 years. The Bureau blames a contraction in mining, while analysts point to reduced personal consumption. The announcement of the slowdown follows the country's downgrade by ratings agency Standard & Poor's from positive to stable. S&P says the stalling of reforms has detracted from Indonesia's growth potential. It also cites slow progress in improving infrastructure, legal uncertainties, and an obstructive bureaucracy. Reserve Bank of Australia cut its policy rate by a 1/4 percentage point. That brought it down to 2.75%, the lowest on record. Central Bank Governor Glenn Stevens cited currency factors for the decision. The Australian dollar has risen sharply against the yen and US dollar in the past year and a half. Stevens said this was hurting Australia's exporters and other domestic industries. He said the reduction was necessary to maintain sustainable growth in the economy. The cut is Australia's first in 5 months. Talks toward a huge regional free trade zone began on Thursday in Brunei. trade officials from 16 countries, including 10 ASEAN members, as well as Japan, China, and India, took part. Organizers of the Regional Comprehensive Economic Partnership, or RCEP, aim to reduce tariffs and promote investment and services to achieve comprehensive economic cooperation across the region. If the pact is realized, it will create a free trade zone with a population of 3.4 billion people and a combined GDP of about $200 billion. The talks will continue until Monday. Members aim to reach an agreement by the end of 2015. Japan's current account surplus for fiscal 2012 shrank to its smallest since 1985, when continuous statistics keeping began. Sluggish sales to China and the EU pushed overall exports down by 1.7% in yen terms to about $600 billion. This is the second year in a row exports have fallen. Imports showed the opposite. They expanded 3.6% to $677 billion. The increase was due to bigger orders for fuel, as well as imports of communication devices like smartphones. The difference between the figures takes the trade deficit to double the previous year, or about $68 billion. Although income balance, including overseas dividends and investment returns, grew to about $145 billion, the trade deficit eroded any overall surplus. The surplus fell 43.6% to $42 billion. Japan is taking part in a consortium that is likely to build Turkey's new nuclear power plant. Japanese Prime Minister Shinzo Abe visited Turkey last week and met with his counterpart Recep Tayyip Erdogan. They discussed signing a pact to limit the use of nuclear technology to peaceful purposes. They also agreed Japan will have preferential negotiating rights on the construction of a nuclear plant in the Black Sea province of Sinop. The project calls for the construction of 4 reactors, whose combined output will be 4.4 million kilowatts. The first reactor is scheduled to start operation in 2023. The plant will likely run the latest reactors developed by a joint venture between Japan's Mitsubishi Heavy Industries and French firm Areva.
Before we go, let's get a check on what's happening in the week ahead. On Thursday, Japanese officials will release a preliminary GDP report for January to March. Many analysts forecast a pickup in growth from the previous quarter. That wraps it up for this week on Asia Biz Forecast. Thanks for watching.
On Masterpiece Classic.
Mr. Woolworth is an American gentleman, I believe.
The West End's big enough to hold us both.
London can accept one American king of commerce, but 2.
You have a very lovely daughter. Where have you been hiding her?
Mr. Selfridge on Masterpiece Classic.
Tonight at 9 on WNED.
Next time, join us as our search for America's hidden treasures takes us to Seattle, Washington.
Even though they're prints and therefore multiples, these are very likely the only examples left.
It's really exciting to see something you've never seen before.
Really? Whoa. Oh my God.
Next time from the Emerald City on Antiques Roadshow.
Monday night at 8 on WNED.
In December of 1942, an audacious operation was launched. A small group of men would canoe into a heavily guarded Nazi port and blow up supply ships. It was one of the most courageous missions of the war, the greatest raid of World War II.